The first half of 2026 tested the Lal Street. Tariffs, geopolitical tensions, a weakening rupee, relentless foreign investor selling, and volatile commodity prices all kept markets under pressure. Now, as Indian equities enter the second half of the year, the key question is, has the worst already been priced in? Or is more volatility still ahead? Business Standard spoke to Shankar Sharma, founder of G-Quant Investec, and market analyst Ambareesh Baliga to understand the key risks, opportunities, and what investors should watch in H2. Before looking ahead, here is a quick look at how the first half unfolded. The defining themes of H2 CY2026 were persistent FPI selling and the surprising resilience of smaller stocks. The Nifty Small Cap 100 gained over 6%, while the Nifty Mid Cap 100 rose more than 2%. In contrast, the Sensex and Nifty declined by up to 10%. Foreign portfolio investors remained relentless sellers, pulling out nearly 2.78 trillion rupees from Indian equities till 25th June.
I never thought FIIs would dump India the way they have in the last year or 2 years. I mean, I've been around for 35, 36 years. I have never seen any situation like this where it was a large-scale exit by foreign investors, because back in the day, we always believed that no matter what happens, India is a chosen place for FIIs and they will keep coming in. Last 12 to 24 months, that whole thinking has been demolished. That's been a big surprise to me personally. Second, in this problematic period, particularly since the war, but say from the middle of March, the mid-cap and the small cap space in India has been doing really well. And that has been again a surprise, although I tweeted about it on March 11th. I put it on record because that was my view, and of course it's my money, I can take any view I want. But my view was that small caps would beat large caps handily, and if you see from that point, that has been another very standout surprise, at least to me.
The next 6 months are likely to be shaped by both domestic and global factors. At home, the progress of the monsoon will be closely watched because it influences rural demand, inflation, consumption, and ultimately corporate earnings.
I think the single major driver for Indian markets for the next month or two would be monsoons. Especially post-July. Since the markets now have discounted that the monsoons will not be that great because the forecast is supposedly worst in the last 11 years. Which means 10% below long-term average. But I think more important is the spread of monsoons, which I think we'll know only by mid-July to end of July. And I think that could be a trigger, either positive or negative.
But even before these factors play out, one question remains. Have Indian markets already absorbed most of these risks? Or is there still room for disappointment? According to Ambareesh Baliga, markets have already priced in most known global risks. However, any fresh disruption around the Strait of Hormuz could still trigger volatility.
Are the markets bothered about what's happening on the Russia-Ukraine front? So it would be a similar case as long as the Strait of Hormuz is operational and there is no major escalation of the war situation in West Asia. Let the accord continue happening. May happen in the next 2 months, maybe the next 6 months. But I don't think people will be too bothered. Crude is expected to remain subdued unless we see an escalation. So crude may not be a major data point as of now, but in case we see an escalation and the crude bounces back, yes, that is another thing of worry.
Shankar Sharma, however, believes Indian equities, particularly large cap stocks, continue to trade at demanding valuations relative to their earnings outlook. His view is that investors may still be underestimating valuation risks if earnings fail to improve.
So I think India is still a frightfully expensive market. Really, really expensive. Anything half decent is still 40, 50, 60, 80, 100 times earnings. It's ridiculously expensive, which is one of the reasons why foreigners don't find it attractive. And I don't think the price moderations have happened enough.
Another major variable is foreign portfolio investment. FPI flows influence both market liquidity and investor sentiment. After nearly 2 years of sustained selling, many investors are hoping for a turnaround. But Sharma believes a broad-based return is unlikely until Indian valuations become more attractive.
I think it will be a while before large-scale buying returns to India. I think valuations have to really moderate, or the market has to fall significantly for the valuations to become more attractive. It's either through time or by fast price action.
Baliga, however, is of the opinion that global investors can stay away from India for a while, but not indefinitely.
We have already seen as to what's happened to the Kospi and the Taiwan markets. I mean, AI-led rally, very narrow, just a couple of stocks moving up, huge amount of FII flows out there. But when they start falling, there is mayhem. Now look at the Indian markets. I mean, they are much more broad-based. The issue here was comparative underperformance of the Indian companies. Hardly any AI exposure, the weakening rupee. But now I think the rupee should stabilize at these levels, or maybe higher. When I say, I mean, the rupee should appreciate a bit from here. And I mean, this can happen possibly when the accord is signed. And the valuations are decent for a fresh entry. So we should remember that global investors cannot afford to ignore a market like India, where we are seeing next 20 years of outperformance. They can stay out for a while, but not permanently. And now it's nearly 2 years, so I think they should be back sooner than later.
So if risks remain elevated, where should investors look? Small cap stocks have outperformed the benchmark indices in the first half of the year. Both experts believe opportunities are likely to remain in select pockets of the market rather than across the board.
Could be
I am very optimistic on small caps. I'm very, very, very optimistic on small caps. So my view remains small caps are amazingly good. They will be risky, they will be volatile. People are prepared to work hard. Find companies, you will make a lot of money there, 100%.
Trend can continue a while longer, but FII will also bring back action in the larger mid caps and the large cap space. But when it comes to small mid caps, the valuations were quite attractive. I mean, even now it's attractive, but it was much more attractive. A couple of months back. And it just needed someone with deep pockets like PMSs, HNIs, family offices, or AIF to recognize this. And that's what they started buying. And the momentum came in. And once the momentum comes in, everyone else climbs onto it.
Sector leadership is also expected to remain narrow. IT has been among the weakest performers this year, with the Nifty IT index down nearly 28%. In contrast, defense, energy and metal stocks have emerged as the market's strongest performers.
IT per se is not going to be an area to make any significant money in. There will be bounces, but I think structurally, to expect them to deliver the goods on AI and new tech and all is, I think, very, very misplaced. By and large caps are not really that attractive, whether it is, your banks, or it's your industrials or your IT services, they don't look particularly attractive.
Most of the other sectors should see outperformance, whether we talk of auto ancillaries, cement, pharma, specialty chemicals, travel and tourism, the BFSI space. I think, even consumption, but that depends on monsoon. So I think we'll have to take a view possibly towards the end of July. Because if that works out better than expected, like I said, you'll see even the FMCG and white goods back in action.
So the second half of 2026 will depend on several moving parts, from the monsoon and oil prices to global central banks, trade negotiations with the US and the return of foreign capital. Volatility may remain high, but for long-term investors, the bigger focus should remain on earnings, valuations and business fundamentals rather than short-term market swings. Follow Business Standard for more stories.